The bull call spread is a powerful option strategy that allows traders to profit from stock price increases. The strategy can deliver higher returns and probability of profit than a standalone call purchase given the same stock price increase, which I'll demonstrate to you later in this video with real trade examples. We'll also cover how the bull call spread strategy works in this video with in-depth trade examples to illustrate how this strategy works in various market scenarios, and I'll also walk you through call spread trades I recently made to secure over $30,000 in profits. You can get this entire presentation's PDF and over 200 pages of bonus content in the free newsletter link down below. Let's get started and explore the basics of the bull call spread options trading strategy. The bull call spread is constructed by buying a call option and selling or shorting another call option at a higher strike price. And the outlook for this strategy is bullish, meaning that the strategy profits when the stock price goes up. For instance, let's say I buy a June 100 strike call option and then I sell a June 110 strike call option. This gives me a 110 bull call spread expiring in June. And if the stock price goes up, the value of this spread is going to increase, and ideally at expiration, the stock price is at or above the call strike that I sold, which in this case would be $110. The max profit of a bull call spread is the width of the spread minus the purchase price times 100, and the max loss is simply the entry cost of the spread. For instance, if I buy a $10 wide spread for $3.30, this means I pay a total amount of $330 for this call spread. The maximum profit potential is going to be $670, which offers me a potential 203% return, and the max loss is a potential $330. This is because an option spread can only be worth the width of its strikes. So in this case, if I buy a $10 wide spread, the maximum price potential for this spread is $10. And if I buy a spread for $3.30 and its maximum price is $10, that means the maximum price increase that I can experience is a positive $6.70. And if we multiply that by 100, we get an actual increase in the spread's value of $670. Before we move forward, I want to talk about understanding call spread prices. A bull call spread's price is the cost of buying the lower strike call minus the money received from selling the higher strike call. So in this example, I have Apple pulled up, and we're looking at 60-day Apple options that expire in April of 2024. Apple is currently at $182.31 per share, and I have queued up the 180-190 bull call spread. This is constructed by buying the 180 call, and we can see that there's a green box around the 180 call, and then selling the 190 call, and we can see that there's a red box around the 190 call. So the 180 call has a mid price of $8.25. This is just the middle point between the bid price and the ask price. The 190 call has a mid price of $3.37. We can calculate the call spread's price by taking the 180 call at $8.25 and subtracting the price that we're receiving for the 190 call, which is $3.37. And this gives us a price for this spread of $4.88, which we can see down here in the middle of the platform. And as we've talked about, the maximum loss potential is going to be $488, which is 100 times the entry price of the spread. This is because we have to account for the option contract multiplier, which basically just means that the listed price of an option, to get the actual dollar value of the option or the cost needed to trade it, we need to multiply that listed price by 100. So this 180 call with a price of $8.25, if I want to buy that, I have to buy it for $825. But for selling the 190 call at $3.37, I actually collect $337 for selling that call option. And so therefore, this price of $4.88 means that my entry cost is $488. And we can see that by looking at the buying power effect, which says 488 DB. This means debit. And this means I need this amount of money to enter this spread, and I need this amount of money available in my account before I can enter this position. The maximum profit is $512, and this comes from the difference between the width of the strikes, which is 190 minus 180. This gives us a $10 wide spread, and if I buy this spread for $4.88, the most this spread can be worth is $10, And so basically, if this spread goes from $4.88 to $10, that is an increase in its price of $5.12. And if we multiply that by 100, we get a total profit of $512 on one spread. Understandably, since we are collecting money from selling that higher strike call, we can think of that as actually reducing the cost of the lower strike call that we are buying. So here in this image, I've just queued up buying the 180 call all by itself. And as I mentioned, the mid price is $8.25. And this means that its actual cost is $825. So if I simply buy the 180 call, I have an entry cost and maximum loss potential of $825. But if I buy the 180-190 call spread for $4.88, my cost basically goes down by about 50% and my risk does as well. And this is why buying call spreads, or the bull call spread trading strategy, is more accessible to traders with smaller accounts as compared to buying call options all by themselves. Here's an example risk graph of a 100-110 bull call spread that I calculated with an options pricing calculator. The stock price at the time of entry is $100, and in this simulation, I purchased a 100-110 call spread with an entry price of $2.66. And this spread had 60 days to expiration at the time of entering the trade. As we can see from this blue dashed line, this is the P&L expectation of the spread at 60 days to expiration. So we can see that if the stock price is at 100 and I purchase this spread, if the stock price goes up, I will start to experience profits, and if the stock price goes down, I will start to experience losses. The solid white line is the P&L of this spread at expiration. If the stock price is at or below $100 at the time of expiration, this spread will expire worthless, and I will be left with the maximum loss potential of $266, which is the amount I paid to enter this spread. The maximum profit potential, however, occurs if the stock price is at or above $110 at the time of expiration. And this means that the stock price is at or above the short call strike price of $110. If that's the case, then I will make $734 on this position. And since I paid $266 for the trade to enter it, that means if I made $734, I effectively quadrupled my money. The key prices to understand here is that if the stock price is below the lower strike price of the position, then both calls will expire worthless and the spread will expire with a value of 0, and I will lose the maximum loss potential. If the stock price is at $102.66 at expiration, the 100 call will be worth its intrinsic value of $2.66, and the 110 call will be worth $0, therefore leaving the spread with a final value of $2.66, meaning I will not make or lose any money on the trade. If the stock price is at or above $110 at expiration, the 100 call will always be worth $10 more than the 110 call, since its strike price is $10 below the upper strike price. And this means that the spread, no matter what the stock price is above 110, will always be worth $10. And that means the value of the position is going to be $1,000. And since I paid $266 for it initially, my profit will be $734. Here's an example of a profitable bull call spread position. This is in Amazon. The entry stock price is around $95, and this spread had 100 days until expiration. The particular setup was to purchase the 90 strike call and short the 110 strike call for a total price of $8.65. As we can see, the call spread value fluctuated throughout the trade as Amazon went up and then went down, providing the trade with profitable and unprofitable periods. As we can see on the bottom half of this graph, we are looking at the price of this call spread. And since the entry price of the spread was $8.65, anytime the spread price was above that number, the trade was profitable. And anytime the spread price fell below $8.65, which it did halfway through the trade here, this trade was unprofitable. Fortunately, at expiration, the stock price ran up in the week before expiration, ending at $106.96, resulting in the 90-110 call spread ending with a value of $16.96. And this means that the trade made $831 or a 96% return per spread. This highlights that when you are buying call spreads, you have the potential to see far higher returns compared to the stock's return itself. But of course, there is also more risk, and let's look at an unprofitable bull call spread example. This is in SPY, the S&P 500 ETF. The entry stock price was $398, and the call spread strikes in this example was to buy the 400 call and short the 420 call. The spread price at the time of entry was $8.51, meaning I have a maximum loss potential of $851 per spread. The expiration was March 2023, which at the time of gathering this data, the spread had 63 days until expiration. This particular setup included an at-the-money long call and an out-of-the-money short call. This gives the trade a more aggressive bullish setup, requiring the stock price to increase to reach the expiration break-even price of 408.51. So that's coming from the lower call strike, which is 400, and we add the spread entry price of $8.51 to get the expiration break-even price of 408.51. In the initial weeks of the trade, we can see that SPY went from $398 up to $418, and this 420 call spread went from $8.51 up to about $14. Unfortunately, we can see that SPY eventually did trickle downwards, and at the time of expiration, SPY was trading at $390. This means that the 400 and 420 call option both expired worthless, and the spread value reached its final value of 0. So in this case, the SPY return was a negative 2% from the beginning to the end of this trade period. However, the call spread lost $851, or 100% of the initial investment. Now I want to walk through some call spreads that I recently traded in MSTR, which is MicroStrategy. First, I want to compare some of the call spreads to compare their prices and potential payouts. In this first image, I am looking at the April 2024 expiration with 141 days until expiration as of this image capture. We can see that MSTR is at a price of $500. In this image, I queued up the 500-700 call spread. This means I was looking at buying the 500 call and shorting the 700 call. The entry price of this spread was $55.22, meaning that the maximum loss potential of this position was $5,522. However, the maximum profit was nearly 3 times that at $14,478. That's because these strike prices are 200 points wide, and that means that at expiration, the maximum potential value of this spread is $200. If I buy a spread that is 200 points wide for $55, that means the maximum potential price increase I can see is the difference between 200 and 55, but we have to multiply that by 100 to get the actual maximum profit. The way I like to look at it is if I buy this $200 spread for $55, I can effectively 4x my initial investment. In this next position, I moved up the long call strike by $100, creating a 600-700 bull call spread. Here, the call spread's width is $100 and the entry price is $20. This means that I can effectively 5x my money, since if I pay $20 for a spread that can go to $100, I can see a 5x increase in the value of my position, and that means that I can make $8,000 on this $2,000 investment. However, since the long call strike is 600 as opposed to 500, this is a more aggressively bullish spread, since I need MicroStrategy to go from 500 and get to approximately $620 by expiration in April of 2024. This is much higher than the 555 break-even of the 500-700 call spread expiring at the same time. So the reason that this 600-700 call spread has a lot higher risk reward compared to the 500-700 call spread is that this call spread is more bullish and has a lower probability of making money by expiration, and this gives it a much higher risk to reward multiple. In this next setup, I've kept the call spread long strike at 600, but I moved out the short strike to 800. This gives me, again, a $200 wide call spread with an entry price of $32.45. And if I buy a $200 wide call spread for $32.45, That means I can effectively 6x my investment because this 3250 can go to a max value of 200. So the max loss of this position is $3,245, while the max profit is $16,755. Again, this is a very aggressive bullish position because the stock price needs to go from $500 to $632 in this case, just to reach break even by the expiration in April of 2024. The spread I ended up trading is the 600-870 call spread expiring in April of 2024. So basically I just took the 600 call and I shorted the furthest out of the money strike at the time, which was the 870. And here we go. I just tried to route the order at a price of $37.70, but that's not going through. So I'm going to cancel and replace. And then I'm going to click the lock to unlock the price, which is going to set the spread price to the new mid price. And then I'm going to reroute the order. So I just got filled at $37.89 per spread, and I purchased 3 of these call spreads with, again, the 600 long call and 870 short call expiring in April of 2024. I entered those spreads on November 30th, 2023, but now we've jumped forward almost a month to December 27th, 2023. So notice now how MicroStrategy is at $664 per share. And if we look at the 600-870 call spread in my positions, we can see that the 600 call was purchased for $53.36, and it is now trading at $145.95. And the total profit on those 3 contracts is $27,777. I shorted the 870 calls for $15.47 each, and since those calls have risen to $56.12, on the total of the 3 contracts, I am currently down $12,195. If we combine these prices into the 600-870 call spread, we can calculate that I purchased the spreads at $37.89, and the current price of the spread is $89.83. That comes from the current price of the 600 call minus the current price of the 870 call. And that means I have a profit of $5,194 per spread. And if we multiply that by 3 spreads total, my current profit at this moment in time is $15,591. So MicroStrategy did trade up significantly, and currently it's at $637 a share. So I do want to close this call spread position. So to do that, I click on the bid price of the 600 calls to set up an order to sell those contracts. And then I click on the ask price of the 870 calls to set up an order to buy back those contracts. Notice on the bottom left, it says next to the 600 call, STC, which means sell to close. And then to the right of the 870 calls, it says BTC, which stands for buy to close. So this is just indicating to me that I am closing this position. I am selling the 600 calls as a closing order, and I am buying back the 870 calls as a closing order. So essentially, I'm just doing the opposite trades that I did to enter the position. Currently, the spread price is $83.15, so I'm going to click review and send, and then I'm going to send the order to see if I can get filled on this trade. That order is not going through, so I'm going to right click, replace order. I'm going to unlock the price, which resets it to the current mid price. I'm going to send the order again, and there we go. I just got filled for a close price of $82.95. I also had some shorter call spreads in January of 2024 that I entered on November 28th. I purchased 3 contracts of the 550, 650 call spreads, and I paid $21.46 for each of these call spreads. As we can see, I did scale out of these call spreads at 3 separate points in time. The first was on December 21st, where I sold one of the 3 spreads for $37.22. And then on January 4th, I sold one of the spreads for $66.95. And then finally on January 5th, I sold the final spread for $60.72. So if we take each of these exit prices and average them out, we get an average exit price of $54.96. And that means my total P&L on these 3 spreads is a positive $10,000. $51. And finally, I also had some 600 650 call spreads expiring in January 2024, and I entered these spreads on December 1st. I actually did it in two separate transactions, so we can't see the spread fill price here, but we can calculate it by taking the $25.45 that I paid for the 600 calls and subtracting the $16.10 credit that I received for the 650 calls. This gives me an entry price for these spreads of $9.35. Again, I exited these trades at separate points in time, about 3 minutes apart. I sold half of the position for $28.86, and then I sold the other two spreads for $29.10. If we average out those exit prices, we get an average exit price of $28.98, and this gives me a total P&L on these four spreads of a positive $7,852. So when we add up the P&L for all three of these call spread positions, we get a realized profit of $31,421. Now, it's really fortunate that I closed these positions because MicroStrategy did end up collapsing shortly after exiting these spreads. If we look at the 550, 650 call spreads in January 2024, we just saw that I exited these for a price of $54.96, meaning I sold them for $5,496 a piece. However, if we look at their current prices, these spreads are trading for $3.45 each, or $345 in value. So if I did not close these spreads when I did, I essentially would have seen all of those profits go almost to zero. And the same is true with the 600, 650 call spreads. Since I exited them for $28.98, or around $2,900 each, and currently they are trading for $90 in value, that means I effectively would have lost 100% of my profits in these short-term spreads if I did not close them out. This is also highlighting what we talked about earlier, which is that if the stock price is below both of the call strikes, close to expiration or at expiration, then the call spread is going to reach a value of zero. So we can see in this image, we do still have 4 days left until expiration, but these 600, 650 call spreads are going to expire worthless if the stock price is below $600 in 4 days. And since there's only 4 days left to go for MicroStrategy to go from $485 all the way up to $600 plus, that means that these spreads have a very high probability of expiring worthless, and that is why the price is effectively zero. Finally, if we look at the 600, 870 call spreads in April, we know that I exited at $82.95 or $8,295 per spread, but currently these spreads have dropped to a value of $28.63 or $2,863 per spread. The April call spread still does have about 3 months until expiration, which is why its price is not zero. It's still trading for $28.63. But this price is much lower than the $82.95 price point that I was able to exit at, because when I exited the trade, MicroStrategy was around $700 as opposed to $485. Now I want to talk about the max value of a call spread. So how can you understand the max value of a call spread? As I've mentioned in this video, a call spread can only be worth the width of its strikes times $100. So for example, if we have a $15 wide spread, if we multiply that by 100, the spread's maximum value is $1,500 per spread. So why is that? Well, let's say I buy the 250, 265 call spread. This means I buy the 250 call and I short the 265 call. If the stock price goes to $300, the 250 call is going to be worth at least $50, while the 265 call is going to be worth $35. This means if I close the call spread, I will receive $5,000 for selling the 250 call that I own, but I will pay $3,500 to close the 265 call that I sold. And this means my net collection into my account is going to be a positive $1,500. So if I initially bought this spread for $600 and its value goes to $1,500, then my net P&L on this trade is going to be a positive $900. So the lesson here is that if you buy a call spread and the stock price goes way above both of the strike prices, the difference in the value of the calls is going to be the difference in their strike prices. So here we can see the 250 call is worth $50, but the 265 call is worth $35. And so there's a $15 difference in their prices. And that's why the maximum price of this spread is going to be $15. But if we multiply that by 100, that means the maximum value of the spread will be $1,500. Regarding exercise and assignment, if the spread is fully in the money and I hold it through expiration, both of these options will automatically get exercised and assigned. This means that if the stock price goes to, let's say, $300 and I hold this spread through expiration, the long 250 call will automatically be exercised and I will buy 100 shares of stock at $250 per share. However, the short 265 call will automatically be assigned, and that means I will sell 100 shares of stock at $265 per share. That means that the exercise and assignment cancels out and I make $1,500 since I'm going to buy 100 shares at $250 and then effectively sell them at $265, therefore making a $15 gain per share times 100 shares gives me a profit of $1,500. Again, if I bought the spread initially for $600 and I make $1,500 on this transaction, my net profit is $900. Now I want to quickly compare the difference between buying a call option all by itself versus buying a bull call spread. I've pulled up the Tesla trade page on the tastytrade trading platform, and I've opened up the March 2024 options with 46 days until expiration. To quickly queue up a call option purchase, Tesla stock closed today at $190.93. And so I'm going to just click on the at the money call option, which is the 190 strike price. This call option is trading for a price of $12.40. This means the max loss potential is $1,240. The break-even price of a call option purchase at expiration is the strike price of $190 plus the amount that we pay for the option, which in this case is $12.40. This means that the break-even of this call purchase is $190 plus $12.40 or $202.40. If I go over to the chart, I can quickly put the break-even price on this chart right here, which is at approximately $202.40. So basically, Tesla has to go from $190 to $202.40 for this option to break even at the time of expiration in 46 days. However, if we were to buy the 190-200 bull call spread by selling the 200 call against this 190 call, we would create a call spread with an entry price of $4.55. This means that our maximum loss potential is $455. The break-even price of a bull call spread is the call option that we're buying, which is $190, plus the amount that we pay for the spread, which in this case is $4.55. So the break-even price of this bull call spread at the time of expiration is $194.55. If I go back to the chart, I can put a line at the break-even of $194.55. So basically, we can see that for this call spread to break even at the time of expiration, Tesla stock only needs to go up to $194.55. But if we simply purchase the 190 call all by itself, we would need Tesla stock to go up to $202.40 to break even on the trade at the time of expiration. And so buying a call option all by itself is a much more aggressively bullish options trading strategy because we need the stock price to increase by a greater margin to reach the break even at the time of expiration. This bull call spread can also reach much higher return potential given the same stock price movement. If we go back to just buying the 190 call, if we enter this trade for $12.40 and we want to see a 100% gain on this position, that means this call has to go to approximately $25 in value. At the time of expiration, this call will be worth $25 if the stock price is $25 above the strike price. That means Tesla has to go to $215 for this call option to be worth $25 at the time of expiration, experiencing a 100% return on this particular trade. However, if we purchase the 190-200 call spread, the maximum value of this spread is the width of the strikes, which is $10. And this is going to happen if Tesla is at or above $200 at the time of expiration. So basically what this means is if we buy this call spread and Tesla goes from $190.93 up to $200 by the time of expiration in 46 days, we will more than double our money because this position will make $545 and the entry cost is $455. So when we compare buying the 190 call as a standalone trade versus buying the 190-200 call spread, we see that we can double our money with a much smaller stock price increase compared to buying the 190 call all by itself. The call spread will also have much less exposure to losses from the passage of time. If I quickly queue up 2 contracts of buying the 190 call, this gives me an allocation or risk exposure of close to $2,500. We can see that my theta exposure is a negative 25.95. This means with the passing of each day, if Tesla's stock price remains the same and implied volatility also remains the same, this call position is going to lose around $26 per day. If I go ahead and queue up the 190-200 call spreads and I bump it up to 5 contracts, allocating around the same as the previous call position, we see that my theta is a negative 2.29. This means, again, with the passing of each day, if Tesla stock price doesn't change and implied volatility doesn't change, this position will lose $2.29 per day. The big trade-off, of course, is that if you buy call options all by themselves, you have unlimited profit potential to the upside, which means if Tesla blasts off to the moon, then the 190 call purchase as a standalone trade can make significantly more profits than this bull call spread, which does have limited profitability. But with the bull call spreads, much less exposure to time decay, the higher probability of profit, and the lower required stock price increase to double our money, the bull call spread definitely has its advantages over standalone call purchases. That'll do it for this video. I really hope you enjoyed it. If anything in this video was confusing to you, be sure to grab my Options Trading for Beginners PDF, which you can find in the link below, and also check out my new and improved Options Trading for Beginners tutorial video that I uploaded right here on YouTube.